Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about MATSON INC quarterly report. MATSON Inc. provides a wide range of businesses and services through its ocean transportation and logistics segments. The company's key offerings include ocean freight transportation services to various island economies, expedited service from China to the U.S. West Coast and South Pacific Islands stevedoring, and refrigerated cargo services in Hawaii and Alaska, inland transportation, container equipment maintenance, and terminal services, multimodal transportation brokerage services, including plus domestic and international rail, intermodal plus long-haul and regional highway trucking plus specialized hauling, flatbed and project, less than truckload, and expedited freight services, less than container load consolidation, and freight forwarding services, warehousing and distribution services, supply chain management services, non-vessel operating common carrier freight forwarding services. The significant drop in MATSON Inc. stock price over the past year can be attributed to several key factors. The company's weak Q3 2025 earnings and lower guidance were major contributors, with a decline in operating revenue and net income from the same period in 2024. Additionally, declining ocean transportation performance was a significant issue, driven by reduced freight rates and container volume in its China service. The muted peak season in the Trans-Pacific trade lane also had an impact, as businesses advanced cargo ahead of anticipated U.S. tariff deadlines, leading to lower demand for MATSON's expedited services. Furthermore, challenges in cash flow management raised concerns about the company's liquidity and ability to invest or manage debt. Overall, these factors have led to a decline in revenue and profitability, resulting in a 33.11% drop in stock price over the past year. The primary drivers of revenue growth or decline in this company can be attributed to a few key factors. On the decline side, ocean transportation is a major contributor, driven by lower freight rates and decreased volume in China. Additionally, logistics revenue has declined due to decreases in supply chain management and transportation brokerage contributions. In contrast, there are no direct mentions of primary drivers for revenue growth. However, it can be inferred that maintaining stable or increasing revenue would require addressing the decline in ocean transportation and logistics sectors. Net income and profit margins decline. A summary of the changes: the company's net income decreased by $64.4 million, minus 32.3%, to $134.7 million in 2025. Compared to a decrease of $46.7 million, minus 13.4%, to $301.7 million for the 9 months ended September 30, 2025. This indicates a significant decline in net income over the past year. Profit margins also suffered, decreasing from 26.1% in 2024 to 15.3% in 2025, and operating income margin decreased by 7.9 percentage points to 20.5%. The possible reasons for these changes include lower freight rates and volume, increased port entry fees, higher direct cargo expenses, and lower revenue in certain segments such as supply chain management and transportation brokerage. These declines suggest that the company is facing significant challenges in its core business operations, which may impact its overall financial performance and competitiveness. The company's financial performance indicates a concerning trend. Despite its efforts, the business is struggling to generate positive operating cash flow. As stated on page 29 of the financial report, operating cash flow is negative. This means that the company is expending more resources than it is generating, resulting in a net outflow of cash from operations. The company's debt level has decreased significantly over the past year, with a reduction of $30 million. This decrease in debt level has led to a corresponding decrease in interest expenses, which have dropped by $5.2 million for the 9 months ended September 30, 2025. Overall, these changes indicate that the company is managing its debt effectively and reducing its financial obligations. The company's financial performance varied across different segments. The ocean transportation segment underperformed, with a decline in operating income and net income in 2025 compared to the previous year. In contrast, the logistics segment maintained relatively stable operating revenue, despite a slight decrease in net income. However, the asset investment segment did not provide clear information on its performance, as both operating revenue and operating income remained stable or slightly increased. Overall, the company's financial results indicate that ocean transportation was the weakest performer among the 3 segments. Management is projecting a cautious outlook for the company, citing several key factors that may impact its performance. Notably, revenue recognition will be based on transit time completed in each reporting period, which could lead to fluctuations in earnings. The company has also discontinued its vessel management services and does not anticipate significant capital needs until the mid-2030s due to a delayed Jones Act build cycle. However, it may face challenges related to fuel prices, sustainability regulations, and climate change, which could impact operations and financial condition. Management is taking steps to mitigate these risks, including using withdrawals from CCF investments to fund qualified milestone progress payments for new vessel construction. Despite these efforts, the company acknowledges that its climate goals may not be met due to delays in fleet upgrade initiatives and significant capital expenditures required for LNG-ready vessels and infrastructure. The company has demonstrated its commitment to returning value to shareholders through two key initiatives in 2025. Firstly, it paid out dividends totaling $33.7 million, with a third-quarter cash dividend of $0.36 per share. Secondly, the company engaged in share buybacks, repurchasing approximately 65.3 million shares for a total cost of $58.4 million. These actions reflect the company's focus on rewarding shareholders and maintaining a strong capital structure. Concerns about inventory buildup and supply chain disruption are warranted. The current business environment is marked by significant challenges that threaten the stability of supply chains. A 10.3% decrease in China volume due to trade uncertainty and volatility highlights the risks associated with global trade. Furthermore, concerns about port entry fees and tariffs affecting vessel entry into Chinese ports exacerbate these issues. Public health crises, quarantines, factory closures, office closures, and port closures have already led to supply chain disruptions. The risks of conducting business in foreign markets are compounded by uncertainty surrounding tariffs, port entry fees, non-tariff trade barriers, or sanctions. Additionally, potential risks due to disruptions in third-party service providers, cyber attacks, natural disasters, accidents, power outages, telecommunications failures, and other unforeseen events further threaten the reliability of supply chains. These concerns underscore the need for businesses to reassess their strategies and prepare for potential disruptions to mitigate losses. That concludes the financial summary for MATSON INC. Feel free to comment below, and I will be happy to answer them when possible.